think a lot of people start to get scared by the IRS, but the tax code was not have you pay the legal most amount of taxes. It was created actually to pay the legal least.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larsen. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's episode, we have Davis Oliver of Taxes Saved. After earning his degree in economics with a minor in entrepreneurship from UNC Chapel Hill, Davis began a career as an analyst for an oil and gas company in Texas. It was during this time that he discovered Bitcoin and Bitcoin mining, sparking a fascination with how emerging assets could serve as powerful wealth building and tax optimization vehicles. Recognizing a significant knowledge gap in the accounting industry, Davis began educating CPAs on advanced tax planning strategies involving alternative investments. His work expanded training over 1,000 CPAs through collaboration with SAM Technology Tax Software, revolutionizing how tax professionals approach wealth building strategies. Today, as leader of the Taxes Saved team, Davis oversees 4 tax strategists and 22 CPAs, led by a head CPA with 10 years of Big Four experience. The firm specializes in serving 3 key client groups: high savers with substantial tax-deferred accounts, seeking Roth conversions, successful business owners, and of course, high-income W-2 employees. So if you're one of these, you need to listen to today's episode. Through strategic partnerships with real estate syndicators, financial advisors, Davis and his team have helped untax millions in tax-deferred assets, converting them to tax-free growth and Roth accounts through the proprietary Taxes Saved planning process. When he's not optimizing tax strategies, David competes in triathlons, explores roads and trails on his bike, and enjoys walking with his dogs and fiance. Davis, great to see you again.
Hey, good to see you, Chris. Thanks for having me back.
Absolutely. This is one of my favorite topics, taxes. And a lot of people, they shake their head when they hear anything tax related. But what we're going to do today is we're going to empower you, if you're listening today, to help optimize your tax scenario. And a lot of you, if you're like me, you just filed your taxes in the past week if you had an extension. I've found, Davis, I've been filing an extension for about 10 years as we have K1s from the investments that we do. We typically file an extension. We got to get our business taxes filed. It can be a real headache sometimes. But the part I like about taxes is looking for ways to optimize. Now, I'm not talking about tax evasion. I'm talking about tax optimization. And you guys at your company, Taxes Saved, do a phenomenal job. We've had a lot of people that we've introduced to your company for the same reason that I first worked with you all, was to figure out, hey, how do we legally save taxes so that we can have more money to put into investments, to donate to charity, to fund things like our businesses. So we're going to dive into all that, Davis. But before we do, we've hit it off for several reasons, least of all that you are a endurance athlete like myself. But I'll let you go ahead and share a little bit more before we dive in.
Yeah, so here at Taxes Saved, Chris, we really help, all types of people that really have a tax burden, right? So we work with clients that are, in their retirement age, that have saved, worked really hard in tax deferred buckets, IRA, 401k, and help them with strategy and planning. Again, like you said, legally, ethically, using the tax code to the fullest benefit, keep more and do more in retirement. Also help, really successful business owners. I was off a client today. He just, 2 days after the extension deadline said, it was a tough pill to swallow, Davis, when I had to write a check between state and federal taxes of $2 million. And I said, yeah, that's a hard pill to swallow.
Wow.
But what are we going to do this year about it, right? And that's the key thing. The sooner the better. And here we are, we're going to save them probably 8 to 9 million in taxes this year, right? So that's for business owners, right? The business owners is typically the ones that can have the most fun underneath the sun of the tax savings realm, we like to joke and say, just in how the tax code's written. But then I don't want to forget about the good old W-2 clients that we really serve at Taxes Saved. A lot of our W-2 clients come to us thinking they're just screwed. There's nothing they can really do. And again, we help them implement strategies that they can as a W-2 employee and keep more of what they, typically just get sucked right out of the paychecks every month. So we serve all types, and everyone's situation is different. That's what keeps this job fun. And been here for going on 5 years now. The Taxes Saved team. There's always new scenarios. new things. And the big thing here is what's changed in tax code and the benefit we have with Trump, with this big, beautiful bill he signed here in July, made it a lot more fun to serve clients this year and going forward. So yeah, it's a little bit about what we do
Yeah.
at Tax to Save, who we serve. A little bit about me. I went to UNC Chapel Hill. I'm an economics major. I actually got started in as an analyst in oil and gas. That's a tax strategy that goes all the way back
Yeah.
to
Love that one too.
1913, right?
Yeah.
And so, now, learning different alternative asset classes and investments out there made me realize that there's a really big way you can start keeping more of what you make. You don't have to, hand it over to Uncle Sam, right? I think a lot of people start to get scared by the IRS, but the tax code was not have you pay the legal most amount of taxes. It was created actually to pay the legal least. And that's really what we do here at Tax to Save is help clients understand that and how it works for their own certain circumstances.
I love how you said that. I've told this story before on the podcast where about 10 years ago I sat down with my accountant and I'll never forget. I like bourbon. He pours me a bourbon. Now this is like
Yeah.
4:30 in the afternoon. And I'm like, he slides it across the desk to me. Now he didn't pour himself a drink. And he goes,
Yeah.
"What number are you prepared to hear today?" And I was like, this is bad because, it's one thing to like share a drink with a friend and celebrate. It's another thing when somebody hands it to you as something to, kind of mitigate the pain you're about to experience. And
Mhm.
we had already paid a large amount of taxes that year. We had some exits with some of our properties, and I ended up having to write a check for the almost the same amount that I'd already paid. And
Mm.
I was like, what happened? I was a W-2 earner. And I said, there's got to be a better way. So we sat down together and we said, how can I structure my businesses and, look for different things, from a tax perspective to save more money and put into investments. And, that was kind of the start to my path towards becoming a real estate professional. I did some oil and gas investments the following year that you mentioned,
Mhm.
which made a big difference. But ultimately, what you said, I can't remember if it was he that said it, but I heard, don't view the IRS as a threat, view them as your partner, and don't view the tax code as something that's, penalizing. Look at it as a guidebook because really the government, and we've seen it with the EV credits, we've seen it with oil and gas, we've seen it with opportunity zones. The US government wants economic growth. They want
Mm.
economic investment. And they incentivize businesses, they incentivize us as citizens to make investments so that we can grow our businesses, ultimately grow our revenues and our income, which means they should make more taxes
Yeah.
overall.
Employing more
And
people, keeping the business running. Exactly.
yeah,
It's a stimulus to the
yeah.
economy, no doubt.
Yeah. So I guess let's start, for those of us or for those out here listening, like if someone's listening today and you just mentioned this, Davis, they say, well, I'm a W-2 earner. My accountant said, or I've heard that there's really nothing that I can do. Why is that wrong?
Yeah, it's wrong because the reality is there is things you can do, right? The most CPAs though, Chris, and I've worked with thousands, and even in just my short career, believe it or not, is that most CPAs, there's not a course of curriculum in the CPA designation on tax savings or planning. It's
Hmm.
filing. It's just they want to, their job and what they've been trained to do, and that's why why is my CPA not bringing me tax strategy, right? It's because most likely they're trained to tell you what you owe, not what you can do to save, right? So it's no insult against your CPA, right? If I had a dollar for every time a client said, "Yeah, my CPA is just not being proactive. They're not putting these strategies in front of me." Well,
That's
that's
not
just
their
not
job.
how that's not what
Yeah.
their job is. That's not what their
Yeah.
business model is, right? So what we help people do, again, of course, CPAs are still vital to it. And every strategy a client would, employ or look to employ with us has been not only approved by a CPA, but we take it a step further at Taxes Saved. Our CPAs also use the strategies, right?
Yes.
So you get
Yes.
that
I've seen that. Yeah.
understanding that it's not only be done and understood correctly, it'll be filed correctly and they'll stand behind what they're filing. And that's a big thing, right? Another thing clients always ask, especially the W-2 earners, to your point there, Chris, well, is this going to get me audited? No, no, it's not. get you audited, right? Because we're going to teach you how to compliantly follow it, right? And so to your point, what can people do, right?
Mhm.
Especially as a W-2 employee, right? Like I said at the beginning, really having a business or an investment in a business that really where the tax benefits come from, right? Some of those tax codes, I'll name a few, right? Things like Section 179,
Yep.
168K, right? Which is bonus depreciation. I'm sure you've been using heavily, Chris, with your
Yeah.
real estate portfolio and helping clients understand that. And so that's where a lot of the W-2 clients, right?
Mhm.
They're busy in their day to day. They don't have time to go get a second job. So we find the legal laziest ways but the legal correct ways to save the most in tax, right? To
Yeah.
compliantly follow. Maybe it's implementing a business, an equipment leasing business. Maybe it's implementing a software as a service business. Things that are depreciable,
Mhm.
things that also can have maybe some benefit leverage, right? But the key for us is the numbers have to make sense, right? My thing, getting started in the oil and gas industry, people, especially this time of year, will just start throwing money at something to some tax.
Yeah.
We joke, we don't want the tax tail to wag the dog, right? That you're just
I
doing
love I love that. If we can just
yeah.
pause on that, I think that's so important.
Mhm.
People say like, "Oh, I can deduct this. I'm going to spend $1 on this. I can deduct 25 cents." It's like, but you're still losing 75 cents.
Yeah.
It's like, yeah. So to your point, like, yeah, don't say, "Hey, I'm not paying tax on this." It's saving me money, not necessarily, right?
Exactly, exactly. Because you don't know how the rest of the investment might play out, right? That's the
Yeah.
uncertainty part. The tax code part is the known. That's the certain. We can really plan and be proactive with that. It comes down to the numbers. The nice piece there is for a lot of the strategies we use, Chris, and help a lot of your clients and people you send our way, is that they might outlay 50 grand strategy. I mean, let's be honest, they cost something, right? So anyone listening today, you think you can save tax by blinking, at the right time and standing on one leg. I wish that was the case, right? I wish government made it that easy for us. But it's really understanding how these assets and strategies work in the numbers behind them, right? And how it works
Yeah.
to your benefit. So, a client might outlay 50 grand, but save them $100,000 in tax. Well, now that that's a return on tax that a lot of people can get comfortable with. And then let's say there's other facets and benefits to that strategy other than the tax. Well, that's kind of the gravy on top, right? We want to walk
Yeah.
away from a strategy that we're saving more than what it cost us to do in the first place. And that's a big thing we provide here at Taxes
Yeah.
Saved so clients understand no client does anything till they understand the benefit to them on the return of tax, what we can really control and guarantee.
I like that. And I remember, when I invest in oil and gas for like $100,000 investment, I may be able to save 80,000 in tax. So my outlay is significantly less. And I might get those numbers wrong, but my outlay was significantly less. But I also got a return over the next several years on my
Hmm.
investment. So it was great because like if you get a 5% return on $100,000, it's 50,000. But if your net outlay is only 20,000, your actual return on your actual dollar out of pocket goes up 5x, and
Yeah.
that's a huge difference. Aside from oil and gas, can you give me another example of some things that specifically W-2 employees may be able to employ?
Yeah, so I'll throw a random one out there. Because
Yeah.
one code is called Section 181. It's actually
Okay.
investing in film financing, right? And so the whole idea here, just like the government gave the benefit to oil and gas back in 1913 with different presidencies, was that hey, you put money out in oil and gas, right? Compared to the movies here in a second, and what we're getting at, that
Yeah.
you're supporting domestic fossil fuel production. You're making fossil fuels cheaper in the great USA, right?
Yeah.
Well, started losing a bunch of jobs around movie production, late 90s, early 2000s. And the US said, hey, let's make movie production great in the United States again. Let's create more jobs, stimulus commerce. So in '03, they passed Section 181 of tax code. And so here we get some great movie opportunities. We've had Mark Wahlberg films. We're working with top-notch producers. These aren't, family friend startup film, right? We know these
I
will get
just
produced.
watched a Mark Wahlberg
Yeah.
film yesterday. It was called what Dirty Play Dirty. Have you heard of that one?
He's got a lot of them. He's got a lot of them. He's
He's got a
got
lot of
all
them. He's
genres now
crazy.
too. He's
He's
all over the place.
crazy. Yeah.
So that one is great because you can outlay, say 50,000 to get a 4.25 times deduction. Well, how are we doing that? How are we getting, if we're outlaying
Yeah.
50 and getting a 215,000 deduction, right? How are they able to do that? And it's in the
Yeah.
financing, right? what makes America great? One of the many things I'd say is leverage, right? Institutional
Yeah.
leverage, financing, right? How are people buying homes these days? They put a certain amount down, right? It's how you've grown your real estate portfolio. Well, the same thing works in other assets, right? And so that financing of what the producer's going out and borrowing money to produce this film, we're part of that down payment. And so we're taking that with the producer. Of course, it's educated risk. These are big time movies that'll make sales and cover production costs. But of course, that's the other reality too. You have to take some risk, right? The government says, hey, whoa, whoa, whoa. If you outlay capital and think you're going to save tax and take no risk, you can do that, but you're only going to save against maybe other types of income like passive. Everyone probably listening to this today is probably got active income, whether they're a business owner, W-2, short-term capital gains, unit Roth conversion, right? That's all active income. So we got to take some risk, right? But it's of course educated risk. But it's that leverage part of that down payment that creates that 4.25 to 1 deduction, right? And that's where we can get a lot more bang per buck of return on tax and have a less of a worry, though it is still a worry. We want to make money on our money too, not just save the tax, but it's less of a concern because of what the tax savings were for us year one of something like that.
Yeah. No, I love it. So what you're saying is, you can invest, say, $50,000, but then you can deduct over $200,000 on your tax. And,
Mhm.
if you're making $500,000 and you're in 35-ish% tax bracket, that's a huge tax savings. That
For
can
sure.
outstrip that initial outlay significantly. Yeah, that was a new one for me when you guys educated me on that. One of my friends that's on your team, I was like, that's really cool.
Yeah.
Yeah, that was interesting. I've heard of there's conservation easements. Now the law changes, and that's what I love. You guys keep up with these changes that go through, and there's new incentives. I mean, shoot, we put solar panels on our roof so like
Yeah.
20 years ago, almost
Hmm.
15, 20 years ago. And it was great because we got a huge tax deduction. We still had a little bit of an outlay, but we got really cheap electricity
Yeah.
because of that for I think it was 7 years, and it increased the value of our house. So that was an example of something else that we did that was pretty straightforward. But those laws have now changed a little bit as well. So I think that's what's great about what you all do at Taxes Saved is that you keep up with the changes and look for the opportunities that the government is incentivizing, today.
Yeah, I'm glad you bring that up, Chris, because you work with a lot of our CPA team already, and I was talking to our lead CPA the other day, and that's what, like you said, I'm learning things every day too in tax code, working with just a great team of expertise and keeping up to date with it. But that's the big thing for those that are listening. Right?
Yeah.
Chris brings up a great point. For W-2 earners and just W-2 earners, this is vital for. There's what's called a business loss limitation, right? That let's say you're making $1 million this year and you're a high income earner and it's all W-2 income, right? The rule right now for 2025 is that you take a max amount of deductions of $626,000 for married filing jointly. Single
Right.
filers, it's half that, 313,
Okay.
right? Well, a lot, with this big beautiful bill Trump signed, right? There's a lot of great things, but the thing he left out, well, here we are again, getting the W-2 people kind of the dirty end of the stick here, is that is now dropping to next year at 512. So instead of 626, the max amount of deduction you could take if you had it is 512, right? And then half that for single filers. So it's really, for those that are looking to save the most they can tax, of course, we got 3 more years of Trump and this big bill. But a lot of people think, oh, he signed that bill and it's permanent. I laugh with clients, let's be honest, is anything in the government really permanent, right? Especially when we change administration. And I think people kind of see the writing on the wall, right? I hope we have, a tax favorable administration, but we kind of saw from the other side, not to get in politics, but it comes into play here when we talk about taxes and tax savings. You know, with that, right, we probably know the writing on the wall that taxes will go up, right? So that the time is
They kind of have to, right?
they have to, right? 38 trillion in debt, ever growing, right? Even this big beautiful bill added 3.3 trillion to it, right? It's gonna someone's eventually gonna be paying this back, and it's gonna come in the form of taxes, we all know.
Yeah, absolutely. And that's why, yeah, I mean, tax, I love the example. People say, hey, I'm going to put money in my 401k and I won't have to pay tax on it right now. And
Mm.
then what they find out is, hey, I'm 25, 35, 45. I'm socking all this money into my 401k. One of the things I've heard increasingly from our clients, our investors, Davis, is,
Yeah.
hey, Chris, I'm stuck having to take these required minimum distributions out of my qualified plans where I have to pay a penalty. And they find out that they're actually in a higher tax bracket now in retirement than they were when they put the money into their qualified plans. And they say, Chris, I don't even need the money right now because I have
Mhm.
all this money coming in from my passive investments, or maybe they still have a business, or maybe their spouses is still working. That's one of the other things you all do is you help with converting that. Can you walk through kind of how that strategy would work for a qualified plan? Because a lot of people know about Roth IRAs, but say, "Hey, I make too much money to contribute to a Roth IRA." How does that work?
For sure. So it was 2010. I throw that data there. The Obama Biden administration that has
Mhm.
allowed us the past 15 years to do unlimited amounts of Roth conversion. But there's a catch. So they'll let you move from a 401k, IRA, 403b, 457, all these different tax deferred buckets, depending on where you're,
Mhm.
what you're saving into in your profession, is they say, sometimes players have different rules there, but let's just say you can convert, is that if you move money from IRA, right, which is pre-tax dollars, to a Roth, which is post-tax dollars and tax-free for life dollars, you have to pay ordinary income tax for the amount you move from, say you have $1 million IRA and you move 100,000, now you owe tax on 100,000 plus on top of whatever you're making. So say you make 200 grand and you move 100,000 from IRA to Roth, now you owe tax on 300 grand.
Mm.
So they get you. They get you on the way in, they get you on the way out,
Yeah.
right? They kind of tempt you to say, hey, we'll give you a tax break now on what you contribute, right? And so hear me out, right? I'll come back to 2010 because it's important date I'll bring up for a reason. But the reality of it is, right, that little tax break now assumes that tax rates won't go up in the future when they start forcing you, like you said, taking these RMDs, right? So there's that compounding risk, right? Because of course you want your money to grow, so you have a nice big bucket in retirement. But if it's too big, right, the RMD is even bigger. And they figure the RMD, they take, for those that are born before 1960, right, it's your age is 73 for your first RMD currently. After 1960, it's 75. So the government wants to, hey, wow, that could be for those listening 20, 30, 40 years from now. And,
Yeah.
all of a sudden, a million, $500,000 today is worth, why Warren Buffett, Einstein considered compounding interest a wonder of the world is because it really is a wonder of the world. I mean, you can turn a million, rule of 72 every 72 years, it doubles, right? So if you're looking 40 years out, $1 million today, you're looking at like 4 million plus, right? And so now they're saying, great, you got your account nice and plump, and now you're the ripe age of 73 or 75. We're going to divide that by what we call the RMD factor. And that's, 26 and a half for those that are 73 and 24.6 for those that are 75. So you get $1 million divided by 24.6, right? That's what they're forced to take is the required minimum distribution. And that's before tax. We see for a lot of clients, like you said, Chris, either they're still working, making good money, right? And then they have to stack that RMD on top of what they're making, right? Maybe it's Social Security, pensions, and now they own tax on top of that. So
Yeah.
they thought they were going to get all of it when they retired, but now they're getting maybe a 2/3 of it if they're lucky, right? Depending on where they are and what state and what bracket they're in. So I
Yeah.
say that's the one risk, the compounding risk with those accounts, right? The tax rate risk in the future on those accounts. But I'll go flash back to why I said 2010. Before 2010, Chris, someone was retired, right? Which most people, that's when they start thinking about Roth conversion. Or if they
Right.
made over 100 grand, can't Roth convert.
Right.
So there's that legislative risk that not to scare people, but history doesn't always repeat, but it can rhyme, I like to say.
Yeah.
And that's our concern is that growth, the tax rates in the future, and then big one, what if they just change the rules, right? And the rule
Yeah.
changing, then it's just too late. So we're big on time value of money, compounding interest, and clients recognize with some of these strategies, we've helped your clients and yourself with use them to offset not just their income short term, this what they're making, but use these deductions to offset Roth conversion income at the same time.
Absolutely. And that's a strategy that I personally use to get money out of our qualified plans,
Hmm.
and avoid that. And I know you've one of our joint friends.
Yeah.
You were going to show a a multi 8-figure savings, which is just incredible just with this strategy alone. So it's really incredible. And we're not talking about a guy with $10 million. We're talking about $3 million, if I recall.
Yeah, I know you're talking about exactly. That's a big one.
Yeah, it was incredible. So, Davis, I'm excited. We're going to do a webinar this evening. So the day we're launching this podcast here, we're going to do a webinar this evening. So I'm going to have the link in the show notes if anybody wants to really dive into some of these strategies. And we're also going to have a link if you want to schedule a free strategy session with taxes saved. But Davis, where can our listeners find out more about your company and you?
For sure. Taxessave.com. Chris, what we love to do is, it's one thing is talk about how we can save taxes. It's another thing to let's see the results, right?
Yeah.
So every week, Wednesday at 6 p.m. Eastern, we release a case study of the week, right? Everyone's scenario is different. Like at the beginning, that's what makes this job really fun, is that everyone's just getting, they have their preferences and everyone has different scenarios of what we're saving them. And so we put that out there, right? We put the return up, we put the results on the right side of the screen, and everyone can now see, oh, maybe that does relate to me, right? I might make $1 million, but I make a couple $100,000 and I have $1 million saved away, right? Everyone's situation is different. And that's what, like you said, we offer, a free consultation to kind of show what is your tax risk, what potentially are some things we can do to help with that. And we're happy to do that here with the Taxes Safe team.
Yeah, no, love it. Take a look, schedule a free strategy session with Davis and his team to check that out. As you all know, at nextlevelincome.com, we strive to teach you how to make, keep, and grow your money. And Davis, thank you for helping our audience understand some strategies and some tools that they can use to keep more of their hard-earned money today.
Hey, pleasure, Chris. Thanks for
Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.